Namaskar. Hello and welcome back to Daily Global Insights. This is episode 360. We took a small break for Navratri and we are back again to give you the latest insights into what is happening around the world. And joining me is my co-host Sridhar Chityala ji. Sridhar ji, namaskar and welcome to PGurus channel, sir.
Namaskar and good morning to everybody, and happy to be back. And after 2 weeks sabbatical.
Thank you, sir. And as you've all been following this, the U.S. markets have been on a downward spiral, and so have almost all the markets around the world. So that keep that in the backdrop. Now we are going to take a look at what happened this weekend or last week, I should say. I beg your pardon. And Sridharji, with your permission, I can start putting up the charts.
Yeah, we'll start with the equity summary, and then we'll go one after the other. So you saw the equities market went down. The first 3 days, the markets was up, and then the last 2 days, the markets began to tamper. The primary reason being some of the data that has come out, especially around the employment numbers. So that simply implies that they expected the unemployment rate to go up, and they expected number of jobs, about 263,000 jobs came in. Now, as a result of this, there is almost guaranteed there's a rate hike. So that has a direct bearing on the earnings. So you saw S&P, Dow Jones, NASDAQ, all down as we wrapped up the week. And once the US markets go down, that cascades down into the European markets, which is the DAX, the FTSE, the London, and the CAC in the France. Same thing happened in the less sensitivity, but having said that, the Asian markets also fell, the Nikkei Shanghai and the Hang Seng Index. So across the equities, you're going to continue to see a downward trend unless we see an uptick in unemployment or a downtick in inflation, or we are going to see some, I would say, a favorable earning numbers, because September 30th just wrapped up. So we will see earning numbers coming out in the next, commencing next week.
Sridharji, before we go to bonds, I have one question for you, sir. So these are all the monetary policy moves that the Fed is making. Now, every time there is a change in the monetary policy, the government is expected to counter that, or to complement that, I should say, complement that with a fiscal policy. What is the Biden administration doing about that, sir?
Well, you're biting both sides of the coin as far as Biden is concerned. So Biden administration, is pumping more money into the system. That doesn't help. That only kind of builds the inflation.
Fuels inflation. Yeah.
Well, fuels inflation. That's number one. Number two is that what it ought to have done, it has not done, which is the primary driver. There are two primary drivers of prices. One is energy. It has done nothing on the energy side, and with the OPEC announcing further cuts in the oil production, we're going to see oil prices back in the $100 to $120 kind of a decision. Since you asked me the question, I will now, I will put an important decision which the Democrats blocked President Trump administration from doing into 2020. When the gas prices were averaging between $20 to $50, the House passed a resolution requesting for 77 million barrels of oil to be purchased and added to the special reserve at a discounted price, somewhere between 20 to 40. And lo and behold, this climate group and the progressive blocked it. Today, Biden is going around asking for gas at $80 to $95. Imagine if they had done that, United States would be selling oil to some of the countries and actually helping its own economy to thwart through the fiscal policy that you are alluding to. We missed the bus.
Yes, indeed. And I have a few questions on the energy part. So I'll wait till then, sir. Let's go to bonds. So these are the bond prices and 10-year for Bundestag and so on. Take it away, sir.
So the 10-year bond, that's the US 10-year bond. That's the first, we have seen that will dip a little bit below 4%. But when we'll show the next chart, you will see why it is. The bond is the German, that's shot up. Okay, the next chart, this is the chart. Now take a look at the, you don't see the 6 months. 6 months is around 4.009%.
It's barely visible. It's visible. It's barely visible.
fairly visible. And then 4.089%. And then you can see the 1 year to 5 year, they are all above 4%. What does that tell you? That tells you that in November, there is going to be a rate hike. And when that happens, you can see these rates recalibrating. So in the longer term, that is 10 years, the rates are expected to fall, which is the reason why it is around the 3.88%. So brace yourself for high interest rates if you are in the market for mortgages in the near term.
So I rudely put you off into the next slide's chart, sir. You're talking about Bundestag, so please feel free, sir.
Yes, I think you can see that the correlation in the euro bonds as well as the Japanese 10-year. Remember, Japanese 10-year was in deflation, was negative. It has moved to 250 basis points. The bond was again around the deflation territory. It has moved up to 2.194%. All this is correlatory to what the central bank, the US Fed, is doing, and most of the central banks act in a coordinated manner in the G7 countries. So that's on the bond markets. Brace yourself. 75 basis points cut around the first or second week of November when Fed is expected to meet, and probably there will be one more rate hike, which we touched on in the last market summary section, somewhere in the early first quarter next year. Now coming to the oil, coming to the oil. Yeah, go on.
Sorry, sir. That's a lot to take for the American consumer, but who are we? We'll just pay our taxes and grumble about it. Please go ahead, sir.
Well, I think that the U.S. consumer is still, showing very strong sentiments based on the savings built around the COVID years. But brace yourself for the mortgage. And when mortgage hits, the recession is almost imminent because that drives significant part of the U.S. economy. Coming to the oil markets, remember we were talking about less than $90 a few weeks ago, Sriji, when markets tapered, and now you see the West Texas is above 90, and so West Texas is above 97, and then the Brent is around $93. Why the prices have risen? Because Russia effectively egged the West Asian nations or the other OPEC nations to cut production to increase the oil prices with imminent kind of economic recession. And so you are going to see oil prices jump to $100 to $120 in the next few months before you see any sign of visibility. Again, two major policy decisions that has impacted, that has given this. First, Biden administration rubbed the West Asian nations on the wrong side when he took presidency. The Great West Asia Peace Accord that was struck by President Trump was cast aside, and he had to go back and basically ask the Saudis whether they would provide additional oil and supplies to the United States, which they declined. Now, Biden administration is even going to Venezuela to ask for oil. So we are depleted on strategic reserve. We have no mechanism. We have cut our own supplies. Now this is going to have a cascading effect into the economy as a result of the supply choke that the OPEC plus countries are going to impose on us.
Sridharji, I have a question here. Now, Saudi Arabia is considered the leader of OPEC, rightly or wrongly. Let's put it aside for a moment. Now, Saudi Arabia has also announced that they are going to launch military operations against Yemen again. Now, US is sort of rubbed in the wrong direction. So US is going to be less inclined to supply more arms to Saudi Arabia. Saudi Arabia doesn't really have an army that can sustain a war. They need some other help. How do you think they're going to manage that part?
Well, I think that it's very interesting that if you remember that some of these issues spilled into UAE and the other adjacent nations. So Saudi has at least collaborated with UAE and other nations. Whether they will step up and be part of this entourage of Saudi remains to be seen. But let's not forget, Saudis do have their F-16s planes as well as the other equipment, and the U.S. defense industry is ever willing to supply to anybody who they don't care any political honchos. They're willing to supply to anybody. So I'm sure Saudi has that in its back pocket, but they're not going to budge on the oil price. I think we have lost that battle. There was some report which was saying that even India is going to be impacted because of the consequences of what's happening in the oil market. Now, India has diversified its supply to a large segment of countries. I think India will manage to some extent. It will also probably still continue to source from Russia and other adjacent nations. And what you call as cushioning the blow that is likely to come from the rising oil markets.
And now let's move on to currencies. Sir, take it away, sir.
Well, I think the current US dollar is strong. Why US dollar is strong? Because it's the only game in town right now, which is the safe haven. US dollar is the safe haven because there's a lot of geopolitical tensions that are going on. So whether it is renminbi, nobody wants to put money in renminbi, nobody wants to put money in ruble, nobody wants to put money in euro, which is, you can see the euro has depreciated by more than 20 to 25%. It's right now, it is less than a dollar, 0.97 to one US dollar. British pound is only 1.10. It was once almost close to a dollar. And then the euro GBP is again, 0.87. So you have seen currencies depreciates almost 20% to 24% once this Russia-Ukraine war started. No different in the Asian markets. Renminbi, which was at $6.40 about a year ago, is now at 7.11. Japanese yen was around 130. It's about 145. AU dollar, which was around 75 cents, is now around 63. So all currencies have appreciated against the US dollar because that's the only market, that's the only safe haven from a currency point of view, and also the pegging of the US dollar.
And viewers, please like this video. We would like to have many more people watching this program. Sridhar ji is a fount of information, a fount of knowledge. He is really giving you something to look forward to. And I can only request you all to, like the video as soon as it starts airing. By the way, tomorrow, as well as all through the week, we'll be broadcasting live at 5:30 p.m. IST. So shout out to all of you to please help us out. Just like this video. Let's move on, sir. Here is commodities, gold, silver, and copper, things that are very close to Indians' heart.
Yes, all prices have reduced. If you're a gold hogger, then it's the right time to buy. From $1,900, we have dipped to $1,700. Whether it'll go to $1,600, I don't know. But clearly, gold, silver, copper has seen almost, from what $5, it has dropped to 3.38. What that is telling you is that all this is indications of recessionary trends in the market around the globe and contraction. When contraction happens, capital expenditure doesn't occur. So you will see things like copper, steel prices coming down, and that is what you're beginning to see in the commodities markets.
Well, on natural gas, Sridhar ji, you want to touch upon that while we didn't have any charts to tell about natural gas?
Yeah, you have a question on natural gas. I think the natural gas prices basically have remained fairly stable, and it has come down. One of the questions that you had asked me is why is US is why US shale gas and natural gas prices not going up? They're just simply not transportable, notwithstanding the fact enough supplies in the US market. So therefore, you are beginning to see that this is the prices that you see in the US market. And second, prices are also correlatory to the demand and supply. If you take a look at Qatar, particularly the West Asian gas supplies, they have already got price locked in to the Asian markets, which is the reason why they could not supply to Europe. And the European market is reliant on our great friend, Mr. Vladimir Putin. So he sets the price in terms of what they need to pay, or he decides not to give them anything either. So that is why you see what the prices that is stated in the market is more the prices that is the US natural gas.
And before we wrap up, look at the agriculture prices. Sridhar ji, take it away, sir.
Yes, agricultural prices has also seen a slide, but I believe this is to be temporary. Wheat, if you recall, was around $1,400, which we talked about, and Modi ji made for India a killing, selling 7 million tons of excess wheat that India had in its storage. Now, some of these price reductions that you see, all across, there's a price reduction somewhere between 20 to 25%, be it wheat, corn, sugar, soybean. I can go to cocoa and so on and so forth. But this is temporary, only reflecting that there was a peace deal between Ukraine and Russia, and the food grains, which comes from those, and as well as across the Black Sea, was almost guaranteed reasonable supply. But that all could change. We can see food prices again going up in the next 2 to 3 months as we see the gyrations of this Russia-Ukraine war, which is, I believe that it is. Nobody wants to sit down and talk and resolve. This includes the West, and Europeans lack leadership, and they should have done something rather than wait for US to do something. And as a result, you are seeing this is the other driver of inflation. Besides oil, food is another driver of inflation. Of course, the interest rates is the other driver of inflation. All this contributing towards challenges that we face today, sir.
Sridharji, before we call it a wrap, look at what you think is going to happen in the markets next week, sir.
Next week, I think, is a very important week. We are going to have consumer price index, that is the CPI number. We are also going to have the earnings season. I can tell you now, based on what little insights that I have gleaned, most of the people reporting earnings, starting with banks, are going to report lower estimates for the year and lower estimates for the third quarter. So that simply implies brace yourself for more downside in the markets as we move towards the end of the year for the last quarter.
Thank you very much, Sridharji. And viewers, please like, share, and subscribe to our channel. We're about 60% subscribers and 40% non-subscribers now. So if I look back 6 months ago, it was 50-50. So many subscribers are coming back to watch our program. So we are doing something right. And thank you for your support. But if you could tell your family and friends and those who have not really, constant subscribers to our channels, please put in a good word or two. Also, feel free to send in your comments, a rich set of comments today. We have tried to address them on the fly today, like, for example, taking care of, touching upon the gas prices and things like that, natural gas prices. So please also click on the bell button for notifications. And if you think that our data was good, our research was good, kindly consider donating using the super thanks button. Thank you very much, Sridharji. Namaskar, and I'll see you tomorrow, sir.
Thank you so much. Looking forward to an exciting week, and glad to be back after 2 weeks of sabbatical. Thank you. Please, once again, I think to reiterate, Sri IRGs, we are counting on your support. We are counting on more people, clicking on the button and continuing to encourage and support us. Thank you. Have a wonderful evening in India, and have a wonderful day in United States. Thank you. Bye.
Thank you, sir. Namaskar.
Namaskar.